Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here. And honestly, we have one of the strangest weeks of market data I have seen in a long time to unpack.
We certainly do. It is Friday, January 23rd, 2026. And looking at the screens, the markets are behaving, let's just call it suspiciously. Usually, when the stock market throws a party, Bitcoin is the first one on the dance floor. It's the life of the party. But this week,
Yeah, this week it's different.
the stock market is partying, and Bitcoin is just sitting in the corner, staring at its phone. Looks miserable.
That is a very, very apt description of what we call a decoupling. And, it's making a lot of institutional investors pretty nervous.
Okay, so to get this, we have to zoom out first, right? Look at the big picture.
Exactly. You have to set the scene. We came into the week with everyone sweating about President Trump's threat of tariffs on European goods.
Right, the trade war fears were back, and that usually means stocks go down.
Precisely. Markets hate that kind of uncertainty. But then, over the last 48 hours, that rhetoric softened. We started hearing talk of a framework agreement.
The politicians stepped back from the ledge.
They did. And the market just breathed this huge sigh of relief. We saw stocks in the U.S. and Europe rally. Hard.
And that's classic risk-on behavior, isn't it? The scary thing goes away, everyone gets brave, they buy stocks.
That's it. Capital flows into growth assets. People sell bonds. They buy things that move fast. And usually, that includes crypto.
But that's the mystery.
That's the mystery. While stocks went up, Bitcoin, it just stalled out.
Yeah.
Completely. It's been stuck in this, $88,000 to $90,000 range.
And it failed to break that huge psychological $100,000 barrier again.
And to make it even stranger, look at what did go up.
Gold, the old school shiny rock, hit historic highs this week. So let me get this straight. Stocks are up, which means risk is on. Gold is up, which usually means people are scared. But Bitcoin is down.
Yeah.
That feels like a glitch in the matrix.
It's not a glitch, but it is a massive signal. And that's our roadmap for this deep dive. First, we're going to unpack why Bitcoin is losing its safe haven title to gold. And there's a sci-fi twist involving quantum computing that's actually moving markets today.
Okay, quantum computing. I'm intrigued. And after that,
Then we pivot to the physical world. We have to talk about Intel. Their stock crashed, about 17%? And it's just a brutal lesson in supply versus demand.
it really is a lesson that having customers doesn't matter if you can't bake the cookies.
You can't bake the cookies, exactly.
I love a good cookie analogy. We'll get to that. But let's start with the digital stuff. Why is Bitcoin acting so heavy when the tariff fears are gone?
To understand this, you have to look at the narrative, the story that's driven Bitcoin for the last 5 years. We always hear it called digital gold.
Right, the whole hard money argument. It's a safe place to park your wealth, away from inflation, away from the government.
Exactly. But the data from this week suggests that story isn't just pausing. It's cracking.
And its competitor is just shining.
It is. On January 22nd, spot gold broke $4,900 an ounce. It's heading straight for $5,000. And this isn't just, retail folks buying coins. Major banks are raising their price targets. Gold is winning the race for safety.
So if this were a marathon for the safety trophy, gold is sprinting across the finish line and Bitcoin is, what, cramping up at mile 20?
Cramping up is a polite way to put it. Big investors are voting with their feet. I mean, we saw a really significant report about Jefferies this week.
Oh, yeah, Jefferies, the big investment bank. I saw this. What their head of equity strategy, Chris Wood, did, it was pretty drastic.
Drastic is the word. He didn't just trim his Bitcoin position in his model portfolio.
No.
He removed 100% of it.
Yeah.
All of it. Gone. And he moved that money directly into gold and gold mining stocks.
Wow, 100%. That implies zero confidence. Is it just him, trying to time the market for a few weeks, a short-term trade?
See, that's the crucial point. This guy, Chris Wood, he isn't a day trader. He manages portfolios with 10, 20-year outlooks for pension funds.
So this is a long-term call.
It's a structural shift. It signals a loss of faith in Bitcoin as a place to store wealth for decades.
Okay, so he trusts the shiny rock more than the digital code for the long haul. But why right now? What was the trigger this week?
The immediate trigger, the thing that actually pushed the price down, is the internal plumbing of the market, specifically the EPFs.
Exchange-traded funds. So this is how most regular people and institutions buy Bitcoin now, right? They just buy a stock ticker that tracks the price.
Correct. And because it trades like a stock, we can see exactly when money comes in or goes out. And according to Bloomberg data, on January 21st and 22nd, we saw massive outflows from these U.S. Bitcoin ETFs.
How massive are we talking?
We are talking about $700 million leaving the market in a single day.
700 million in one day. That is a huge amount of sell pressure.
It's huge. And you got to remember, the crypto market is way thinner than the stock market. You dump nearly $1 billion of sell orders in 24 hours. The price is going to drop.
So that selling pressure just completely overwhelmed any good vibes from the stock market rally.
It did. But the question is why? Why are they nervous? Why did Chris Wood switch to gold?
Right. You mentioned a sci-fi twist.
Yes. And this is where we have to talk about a report from the City Institute about quantum computing.
Quantum computing. Okay, I feel like I've been hearing about this for 10 years, and it's always 10 years away. Why is it moving markets in 2026?
Because markets don't price things based on today. They price them based on tomorrow's risk. The fear in the report is that quantum computers could eventually become powerful enough to break the encryption that secures Bitcoin.
Okay, let's break that down. Bitcoin relies on math cryptography to prove I own my coins. You're saying a quantum computer could just solve that math?
Theoretically, yes. It would take a normal supercomputer millions of years to guess your private key. But a powerful quantum computer could potentially do it in hours.
And if they have the private key, they can empty the wallet.
Exactly. Now, to be extremely clear, this is not happening today. Nobody is hacking wallets with quantum computers right now. The tech isn't there yet.
So if it's not happening today, why is the market freaking out? That feels irrational.
It's about terminal value. If you're a pension fund buying an asset to hold for 30 years, you need to know it will still exist in 30 years.
Ah, okay, I see. It's like buying a house to store your family fortune.
Perfect analogy.
Yeah.
You have two options. Option A is gold. Think of gold as a castle made of stone. Heavy, physical, primitive. It's been there for 1,000 years.
Stone castle. Hard to break. Nobody's going to hack a rock.
Right. Option B is Bitcoin. It's a high-tech digital fortress. Laser grids, mathematical force fields, super convenient. You can send it anywhere in seconds.
Yeah.
But suddenly there's a credible rumor that someone's inventing a new super laser that can melt those force fields.
And even if the laser isn't built yet, just knowing it might exist makes my high-tech fortress feel like a really bad place to put my life savings.
Precisely. If you're Chris Wood, you look at the fortress and say, you know what? I'll stick with the stone castle. Stone doesn't need a software update.
That's fascinating. The innovation of Bitcoin is also its vulnerability. Gold's lack of tech is its best feature.
And that's why Bitcoin is acting like a risky tech stock right now. It's trading on the probability of its future failure.
Okay, so speaking of trust cracking and technology failing, let's pivot from digital chips to physical chips.
Yeah.
Let's talk about Intel.
Yes, Intel. If you're an investor who loves a turnaround story, this one really hurts.
The headline is brutal. Intel stock crashed about 17%. But context is key here. Before this, the stock had rallied like crazy, right? Almost 50%.
That's right. There's this huge hope trade happening. The market saw the AI boom, saw NVIDIA making billions, and thought, well, Intel makes chips too. A rising tide lifts all boats.
Seems like easy math on the surface. If everyone needs chips and Intel has factories, they should be winning.
That was the hope. But then Intel released their earnings, and pop it. The balloon popped.
So what went wrong? The data says they're supply constrained. Now, usually that sounds like a good thing, like we're so popular we can't keep up.
In retail, yes. But in semiconductor manufacturing, being supply constrained is a disaster. It means you are just leaving billions of dollars on the table because you are inefficient.
It's not that people don't want the product, it's that Intel can't make it.
They physically cannot make the chips fast enough or well enough to meet the demand.
Yeah.
And the core of the problem is a concept called yield.
Yield. Right. Can we define this for people who aren't engineers? When I hear yield, I think of a traffic sign.
Let's stick with a bakery analogy. Intel's factory is a high-end bakery. There's a line out the door. Everyone wants these new AI cookies.
Okay, demand is there.
Right. So you put the ingredients for 100 cookies on a tray and put them in the oven. Expensive ingredients.
But
when you pull the tray out, you check the cookies. In a perfect world, you have 100 perfect cookies to sell. But because Intel's oven is finicky, their new 18A process, maybe only 40 cookies are perfect.
and the other 60.
Burnt, crumbled, useless. You have to throw them in the trash.
Ouch. So you spent the money to make 100, but only get revenue from 40.
Exactly. That is low yield.
Mm.
And it kills your stock price because you still paid for the electricity and staff to make all 100. Your profit margin gets destroyed.
And the 60 customers who didn't get a cookie, they just go across the street to the AMD or ARM bakery.
Who are using TSMC's factories, which have much better ovens. And yes, according to the reports, the CEO admitted the yield on 18A just isn't where it needs to be.
And this ties into their whole big strategy, right? The foundry business, being the factory for other companies.
This is the central problem. It creates a catch-22.
How so?
Intel is telling customers, we won't spend billions expanding the factory until we get firm orders. But the customers are looking at these burnt cookies and saying, we won't give you firm orders until you prove the factory works.
It's a standoff. Show me the money versus show me the product.
And right now, they have interest, but no huge commitments. They're stuck.
I have to play devil's advocate here, though. They beat revenue expectations for Q4, $13.7 billion. If they beat the number, why the 17% crash?
This is a classic lesson. It's called pricing in perfection. Remember, the stock had just gone up 50% on pure hope.
So the bar was set incredibly high.
So high. And while Q4 was okay, that's backward looking. The forecast, the guidance for Q1, it was weak. In investing, it's not about yesterday. It's all about what you say you'll do tomorrow.
And Intel basically said tomorrow is going to be hard.
And the market ruthlessly repriced the stock to match that new, harder reality. Wiped out almost all the hustle in one morning.
It really is all about execution, isn't it?
Everything.
So let's connect the dots. We have Bitcoin struggling with a future risk and Intel struggling with a today problem. What's the common thread here?
If you zoom out, the common thread is trust.
Trust. Okay, break that down for me.
With Bitcoin, it's losing trust as a safe haven. Investors are asking, can I trust this code to be secure for 20 years? And for some, the answer is no. So it's a crisis of confidence in the technology's longevity.
And Intel.
Intel is losing trust in its execution. Investors know the AI demand is real, but they don't trust that Intel can physically build the product to capture that demand.
That's a really powerful way to look at it. It's not just the price, it's the story underneath.
And in both cases, the story is broken. Digital gold for Bitcoin, the great American foundry for Intel. Until those stories are fixed, the prices will struggle.
So for our listeners, what should they be watching? The cheat sheet.
For Bitcoin, ignore the daily price swings. Watch the ETF flows. Is the big money staying or leaving? That tells you the real story.
And for Intel?
Watch the yield. Forget the hype. Listen for any news on the 18A process. Can they fix the oven? Until then, the stock is dead money.
Those are great takeaways. Before we wrap, one final thought to leave us with. Something to keep us up at night.
Well, let's go back to the sci-fi twist. We talked about quantum computing threatening Bitcoin, and we treated it like a crypto problem.
Right. If you don't own Bitcoin, you might think you're safe.
But if that technology matures, I mean, the math that protects Bitcoin is the same math that protects your bank account, your email, national secrets.
Oh, so if the Bitcoin fortress falls.
It falls for everyone. If quantum breaks crypto, it effectively breaks the internet's security model. Maybe gold really is the only thing you can't hack.
Well, that is absolutely terrifying. I might go bury a gold coin in the backyard after this.
Not investment advice, of course.
Of course. Thank you so much for breaking all this down. Don't forget to subscribe and hit that like button. We'll see you in the next deep dive.